Okay, class. Good morning, everyone. I welcome you again to another class. And today, objective is to to start and finish IAS 8 on accounting policy, changes in accounting estimates and errors. But before I proceed, I need you to confirm that you can hear me clearly. Anyone?
Yes, we can.
I hear you, sir.
Yes, we can hear you.
Yeah, you are clear,
Fantastic.
sir.
Fantastic. Okay, so let's quickly look at this standard. Now, IAS 8 is a very fundamental standard as regards to preparation and presentation of financial statement. It is at the very heart of every of the standard, in that without IAS 8, preparation and presentation of financial statements will not be coherent. It will not be structured. We're not going to achieve that fair presentation that we want. So IAS 8 is important and is a generic standard because it cut across all of the other standards. Now, this standard looks at three areas. It looks at three areas. Of course, from the name of the standard, it is clear the areas this standard looks at. Let me just repeat it. We're going to look at what an accounting policy is and how to select and apply an accounting policy. Also, we're going to look at accounting estimates, what they are, and how to effect changes in accounting policies. Also, we are finally going to look at errors. Of course, you should know that what is relevant in looking at in errors is just basically the correction. It's just basically the correction. That's the only relevant thing we need to look at there, because errors would always happen. So let's pick them one by one and look at what IAS 8 has to offer regarding each of them. Let me start with accounting policy. And let's go straight to what an accounting policy is according to IAS 8. IAS 8 says that it says accounting policies are the rules, the principles, the basis, the conventions, and the practices that are applied in the preparation and presentation of financial statements. Accounting policies are the rules, the principles, the bases, the conventions, the practices. That goes to show that from this definition, we can say confidently that an accounting policy is basically the accounting standards and the conceptual framework. So from this definition, accounting policies are the accounting standards and the conceptual framework. Because why I'm able to conclude that is that when they said accounting policies are the rules, the principles, the basis, the convention, that's accounting standard. That is what accounting standard does. Accounting standard can be the rules, the principles that are applied in preparing financial statements, and also the conceptual framework, because conceptual framework are used, they are the tool that are used to develop accounting standards. So when they say accounting policy are also convention, then they are referring to the conceptual framework. And you see, realistically, accounting policy even goes beyond accounting standards and conceptual framework because they are also practices in the sense that if there are issues in practice that are not captured in an accounting standard or a conceptual framework, and you need an accounting policy, you can use standard practice. You can use the way it is done in practice. Though that is not common, it's rare, the conceptual framework is robust as of now, that there is hardly any issue, any accounting issue that it does not cover, even the accounting standard. So it's highly robust, that it has covered major issues. But I just need you to know that if such arises, we can use industry practices or standard practices as the basis for our accounting policy. Now, the key question that should be going through your mind right now is that why are we talking about this? Why are we discussing accounting policy again when they are just accounting standards and the conceptual framework? When they are just accounting standard and the conceptual framework, why are we discussing it again? Since we're already teaching us all the accounting standards. You see, why we have to talk about accounting policy is that every organization needs to tailor accounting standards to their operations. They need to tailor conceptual framework and accounting standard to their activities. Organizations have varying activities. There are some organizations that might not have certain assets. They might not even have PPE at all. There are some that the nature of their PPE will be different from another. So because of the very nature of different businesses, we need each of those businesses to tailor the accounting standard to their need. And the way that is done is through accounting policy. So we expect every organization to select an accounting policy. There is no financial statement you would open today. The first thing you will find in the notes to their financial statement is the statement of accounting policy. And what the statement of accounting policy basically contains is just the rules and principles you have applied, the standards you have applied in preparing your financial statement. So by the time we look at your financial statement and we see revenue in your financial statement, you should tell us which standard did you apply? How did you apply? That is your accounting policy. If you have research and development in your financial statement, you need to tell us the standard that you apply. How did you apply it? If you have financial statement in if you have financial assets in your financial statement, you need to tell us which standard did you apply and how did you apply it. You see, informing the users about the accounting, about the standards, the conceptual framework that you have applied in preparing your own financial statements. What you're doing is you're presenting and selecting accounting policy. So you find out that every company would have their own accounting policy. They would have their own accounting policy. So, having understood that introduction, like I've explained earlier, every organization is expected to select accounting policy. And accounting policies are selected using either the IFRS that deals with the item in question. So if, for example, you got a government grant, you got a grant from an international community and you want to account for it. If I want to understand the way you have accounted for that government grant, I should be able to go to your accounting policy and see the way you want to account for that government grant. And your accounting policy should state clearly that, okay, for the government grant, it was accounted for in line with IAS 20, and IAS 20 requires that, just tell us. So when you want to select accounting policy, you use the IFRS that deals with the item. Now, it's possible, it is possible that you have an item or a transaction in your account and we don't have an IFRS for it. It's possible that you have a transaction and we don't have an IFRS for it. There is no standard for it. So if you have that situation, then how do you select accounting policy? Then you will use the definitions of elements of financial statements in the conceptual framework. That's when you would then rely on the conceptual framework. You look at the elements because all the transactions you can have as a business cannot be outside the 5 elements: assets, liabilities, income, expense, and equity. So by the time you look at the definition given in the conceptual framework, we believe that should guide you. That should guide your selection of your accounting policy. However, if that cannot work, then, so if the above does not help the entity in selecting accounting policy, then IAS 8 suggests, it's not compulsory, they just suggest that the entity should rely on the following. Number one, the IFRS of a similar item. So if there is a similar item or a transaction to that transaction in question, then you can use that to develop and select your accounting policy. If that does not help, then you can apply the accounting standards of other nations that uses similar conceptual framework to develop their standards. So you can look for accounting standard in another country in as much as they use a similar conceptual framework as that used on IFRS to develop their standards. And if that still does not help, you can use the industry practices or other accounting literatures. So if there are accounting literatures that are available, then that can help, or industry practices that can actually help you to select your accounting policy. So this is how we select accounting policy. So the compulsory one as required by the standard is these two, which is the IFRS that deals with the item, and also the definition of elements of financial statements in the conceptual framework. We believe that these two should help you. It has always helped in selecting accounting policy. But we're now saying in extreme cases where the item is so unique that there is no IFRS that deal with it, or the conceptual framework does not cover it, then that is when this one is suggested. You see that is a suggestion, that we suggest that, not that we are saying you must. It's a suggestion. Now, that's how we select accounting policy. Now, note that when accounting policies are selected, an entity must apply them consistently. It must be applied consistently. We take consistency very seriously in reporting. We don't expect you to change accounting policy anyhow. So if let's say you bought an item, you bought an investment property, for example, and you go on to IAS 40. I've not taught you IAS 40. Let me go to which standard have I taught? IAS 37, for example, provisions. There you had a court case and you go to IAS 37 on the policy you want to choose, on how you want to measure that provision. Then you're able to select that, okay, this provision should be measured based on expert opinion and past experience. And you choose a measurement basis for your provisions. So we don't expect you in subsequent years to change that measurement basis or the approach with which you use in measuring that provision. So if you have used like if there are multiple outcomes and you have used a particular ratio, a particular way in computing the amount you might be expected to pay to settle that provision, you expect that you stick to that approach. So we don't expect you to be changing policy anyhow. So when an accounting policies are selected, it needs to be applied consistently. Now, it's important to also note that ISA then talks about changing accounting policies. That yes, we don't encourage that you should change, but a change in accounting policies are permitted if, number one, If number one, it is permitted by an IFRS, if the change is permitted by an IFRS, or let me not say permitted, let me see if it is required by an IFRS, meaning that it is compulsorily required. If it is required by an IFRS. Number two, if it will result in a reliable and relevant presentation of the item in question. Meaning that this one is a voluntary change in accounting policy. So these two, if they exist, then we can be looking at, yes, you can change. So if it is required by an IFRS, we are looking at, for example, when IAS 23 was updated, for example, before in the old IAS 23, all borrowing costs, in fact, borrowing costs can either be expensed or capitalized. That was the requirement of IAS 23. But when IAS 23 was updated, that came with saying that all borrowing costs must be capitalized. So the old IAS 23 requires borrowing costs to either be expensed or capitalized. So you will find at that point, any company that has borrowing costs, they will state it in their accounting policy that, okay, we can either expense or capitalize our borrowing costs. But when it was updated, it required all borrowing costs to be capitalized if it is directly attributable to the acquisition of that asset. That means it becomes necessary. It becomes compulsory that you have to change your accounting policy. And another one is when IAS 17 was updated to IFRS 16. See, in the old IAS 17 on leases, it requires the lessee to classify a lease into operating or finance lease. But when it was updated to IFRS 16, the lessee is no longer required to do this classification. Only the lessor now makes such classification. So that would force organizations to change their accounting policy because of the change that was required by an IFRS. IAS 17 says, okay, let's see, you can classify leads into operating or finance. But when IFRS 16 came, he said, no, it's not necessary. Just recognize right of use assets and lease liability. Another one is when IAS 39 was updated to IFRS 9. In the old IAS 39, financial assets were impaired using an incurred loss model. But with the new IFRS 9, financial assets are now impaired using expected credit loss model. So the list can go on and on. So this change in accounting policy is permitted in these cases because it is required by an IFRS. However, the one that is a voluntary change in accounting policy, which means that you believe that it will result in a reliable and relevant presentation of the item. In such cases, we are looking at a scenario, for example, where an entity changes, let's say an entity changes from cost model to revaluation model for measurement of PPE or intangible assets. This one is not the standard that will require that you should use, that you should change, because you will have selected how you want to measure your intangible asset. So if you now decide to change, probably because you believe that the asset has now become volatile and using cost model is no longer a good representation of that asset value, that is important that you change, then that's a voluntary change in accounting policy. If you believe that, okay, but you need to justify it very well and state it in the notes that this change from cost model to evaluation model will result in a better presentation. It aligns with the way the nature of the asset is now in the industry, or where you decide to change from FIFO to weighted average for inventory valuation. This is also a change in accounting policy that you believe will result in a better valuation of your inventory. I mean, and you need to explain. You need to justify why you believe that this change is important. Probably because you believe maybe you are in an inflationary environment and you think weighted average will help you neutralize that fluctuating prices in your inventory, and your valuation becomes stable, something like that. Instead of using FIFO, where the value will be undulating and completely unreliable. But you need to explain whatever it is you believe is the reason why you are changing. Users need to see. Or you want to change from cost model to fair value model for measurement of your investment property. The list goes on and on. But these are voluntary and you need to justify it. So the important point here is this. When it comes to accounting policies, I've already stated it clearly here that make sure you hardly change your accounting policy. It's not something we encourage. When accounting policies are selected, an entity must apply them consistently. We then now say that, okay, oh, you can change if it is required by an IFRS. And I've told you examples, and you will see that these examples means that the company does not have any choice but to change. And two, we say if it will result in reliable and relevant presentation of the item, that one is voluntary. So in changes like this, we need the organization to justify, and it has to be satisfactory to the auditors. Otherwise, it will not be permitted. You have to justify. You don't just change without proper justification, especially for voluntary change in accounting policy. It will not be accepted. Now, when you change accounting policy, how do you treat it? Application of changes in accounting policy. Because accounting policy, like I mentioned, it affects how you recognize, how you measure, how you present. Because that's what accounting policy is anyway. You're explaining to us the basis for recognition, the basis for measurements, how you have presented the item in the accounts. That's accounting policy. Now, when it changes, it has a high-reaching effect in the sense that that consistency that we want to achieve might be lost. It might be lost. So we then say that where a change in accounting policy is as a result of a voluntary change in accounting policy, you see, the effects of the change in accounting policy must be applied retrospectively. That is, it should be effected as if that is the policy that the entity has always applied. So where a change in accounting policy is as a result of a voluntary change in policy, it's voluntary. You're the one that decide that, okay, for a more reliable and relevant presentation, you want to change from one valuation method to another, from one basis to another. It's fine. But we don't want to defeat consistency of figures. Therefore, you must be ready to apply that change retrospectively. That is, the change should be effected as if that is the policy that the entity has always applied. This means that the entity will need to effect the change on the opening balances of the assets, liabilities, and equity of prior periods presented. So you might be required to effect the change on the opening balances of prior period presented. And as a result, the entity will be required to present an additional statement of financial position of the earliest prior period presented. What we are saying here is this. Let's say the current year is 2025. We usually present comparative period for 2024. That's how we prepare accounts. So when you are preparing your 2005 accounts, you must effect the change in accounting policy on 2024 account. In fact, you might be required, in fact, you are required to also present figures for January 2024 in a way that we want you to start effecting the change from this earliest prior period, the opening period of that comparative period. So your statement of financial position will now be 3. So when an entity presents their 2025 accounts, they will always present comparative period for 2024. So in addition to this one, when you are applying a change retrospectively, IAS requires that you must now present statement of financial position for January 2024 in such a way that you will start effecting that change from January 2024. Everything they want to achieve is just so that it will look as if that's the change you have always applied. It will look as if nothing has changed in your account. But don't confuse this with the fact that saying you will go and change an account you have published already. No. Everything is happening in the current year. When you're presenting your current year financial reports, then you can then update. And what you are changing in the comparative and earliest is just the opening balances of assets, liabilities, and equity. That's just where the changes would be effected. But where the change in accounting policy is as a result of a compulsory change, meaning that is required by an IFRS. So the change will be applied in line with the transitional provision that accompanies the new IFRS. So when an IFRS comes in, there's usually something we call transitional provision. So, and that transitional provision will explain how you're supposed to apply changes in accounting policies. It will explain it. In such cases, then use the transitional provisions. And that is it for application of change in accounting policy. So what you need to note here is this, what they will ask you in the exam for every one of you here today is the fact that you need to be able to understand very well the idea behind retrospectively. And I already explained that it's just to ensure that consistency is not defeated, that you should let the policy change look as if that's the policy you have always applied, and all those changes are happening in the current year of the change. So in that, when you're presenting your financials for the current year, which I said if it's 2025, then the comparative period that you are presenting, it will now be a restated comparative period. You will need to restate it by adjusting those change. If you are, let's say you are changing from cost model to evaluation model, that means all your assets that you use at cost model in 2024, you restate it to evaluation model. And you also present if you also present earliest power period too, that is opening of the comparative period. You also do a restated balance there as well, all in this current year report. And that's what we are that's basically what I need you to note here. But if the change is a compulsory change, you need to be able to tell the examiner that where the change is required by an IFRS, then we rely on transitional provision. So let the transitional provision tell us how we should apply the change in policies. Every new standard has a transitional provision, how you should apply it, what you should do. If there is any change in the way you were using this standard before, how should you effect those changes in prior periods? That is majorly what this looks at. And finally, is disclosures requirements. Disclosures requirements for accounting policies. One is you need to tell us the title of the accounting policy. You need to also explain to us the nature of the change. If there is a change in accounting policy, you need to explain the nature of the change in accounting policy. Also, you need to also tell us why the change in accounting policy, why the change in accounting policies will result in a reliable and relevant presentation. You need to seriously let us know. And also is that the adjustments that was made in the current and the prior period presented. So you need to really give us these disclosures, the notes to the account. Okay, so I'm done with the first part. How long did it take us? Wow, almost 40 minutes. Okay, this is the longest part anyway. So that's accounting policy for you. You need to understand it at the simplest level of it. You need to understand the fact that every company is required to have an accounting policy, and all accounting policy talks about is you need to tell us how you have recognized each item in the report. You need to tell us how you have measured the item in the report. You need to also tell us how you have presented those items. And of course, you don't just start telling us from your own understanding. You tell us based on the IFRS that deals with the item, or if there is no IFRS that deal with the item, you rely on the definition of that element in the conceptual framework. Then if that does not help, that is where you go to all of these other requirements. And when you select, be consistent with it. But if it is compulsory, you have to change, then it must be required by an IFRS, and you have to be sure that it will result in a reliable and relevant presentation. And when we say required by an IFRS, it means there was a change or an update in an IFRS that requires that. And when the change would result in reliable and relevant presentation, you have to justify, you have to explain. And when you eventually change, you see, when you're applying it, you must apply it as if that's the policy you have always used. Meaning that in the year of change, you need to then restate comparative period and the opening of that comparative period, the earlier period presented. You need to restate them in this current year, so that by the time we are comparing your figures, when you look at least we are looking at 3 years, that consistency is still there. It has not been lost. But where a change is required by an IFRS, then you should rely on transitional provisions to guide us on the application of that change. And these are some disclosures required where you have accounting policies or changes in accounting policies. Do I have some questions before I move to accounting estimates?
Hello, sir.
Yes, performer.
Sir, good afternoon.
Hi, good afternoon.
Like these changes in accounting policy, you said that means if we are changing any policy, we'll have three comparative financial statements: the current, the comparative period, and the earliest prior period. I want to understand it clearly. Can you just use figures to explain how the earliest prior period will be? Like for assets, we'll say that the opening is not like this, then the comparative period is still 2024. The closing would not be adjusted, or I don't understand the scenario.
That's exactly how it works, the way you have mentioned it. So, if you are preparing your 2025 financial position, for example, let's say you have PPE, right? Let's say you have PPE and you have 2025 figures that you are not presenting in line with let's say you are now using evaluation model, you know that you will have comparative. Let's say in your last year report, it might be there at 800, but because you are using evaluation model now, it should now be 900. You will have done your calculation. So you just put in brackets restated. Then also January 2024, let's say your PPE before there was 700, but now revaluing, probably it's now be 850. So these are just hypothetical figures that I'm using. But again, this one too, you put restated. Okay, so you might not really see any ICAN question that would ask you to be doing all of this. So this I'm explaining to you is particularly important for those of you that are working as auditors or you're actually in practice. So most ICAN question you will just be majorly for these 2 years. Everything, they'll ask you to adjust statement of changes in equity. So you will not see them. I've never seen an ICAN question asking you to do all of this. So when we solve questions, you will see. But in real life, when companies change accounting policy like that, this is how they would present their 2025 reports. 2025. The 2024, they will put restated. If you go and pick up their 2024 account, you will see that it will not be 900 you will see there. It might be maybe 800, the figures they used before. But because of that change now, they have changed it. The same thing the opening power period presented also, they will change it too. So to 850. If you go and if you go and check their 2023 reports, it won't be this 850. It will have been the value using that old model that will have been there. And that's how it works majorly like that. So I hope that's threw more light for you.
Yes, sir. Yes, sir. Okay. Thank you.
Okay. Any other questions, please?
Yes, sir. I have a question.
Okay, please go ahead, Winnie.
Sir, please, this in IAS 30 is talking about consistency. Is it that, let's say, for instance, in 2023, let's say for classification of assets and depreciation, maybe in 2023, you used a straight line basis, and for 2024, you revalue the assets and you now want to use a reducing balance method. So is it that the entity should continue with straight line basis forever, or just for that particular period, maybe when they are reporting for 2023 and they want to change the policy, they'll have to change it for the next reporting period, like 2024? That's what I want to understand.
Okay, so let me just restrict it to the fact that consistency means forever.
Okay, sir.
Yes. So I don't want to talk much because the examples you were using, changes in depreciation method is not a change in policy. It's not a change in policy, it's a change in estimate. So, but I think the major thing you want to understand is when we say consistency, does it just apply in the current year or all through the years? When we say
Yes, sir.
mean all through the years. Don't change whatever accounting method or approach you have selected, including accounting policies. Don't change.
Okay, sir. Then, okay, secondly again, sir, what if, let's say for an asset, probably you know that this particular asset is no longer using a straight line basis to depreciate the assets is no longer good for it. Probably the cost of that, the present cost of that asset, it's no more worth the price. Maybe you acquired it maybe 2 years ago. Is it still advisable that you continue using straight line basis when you know that the actual cost is not really what it's obtainable at the market?
So that is where the second approach might actually apply. But straight line method does not really have that impact like you wanted to present, okay? I think the example you would have wanted to give is that instead of them using a cost model where they will continually depreciate the assets and the carrying amount of the assets is now at a figure that is not realistic. And when you compare it to what is happening to the assets looks as if it has much more value than the amount you are carrying it in your books. Then in that case, yes, that can be a justification for a voluntary change in accounting policy from a policy of cost model to a policy of evaluation model. That can be a justification. But when you do such change to evaluation model, it has implications too, because it means you need to be ready to be revaluing the asset periodically. depending on the volatility in the value of the assets, like that. So that can work in such cases.
All right, thank you, sir.
You're welcome.
Please, I have a question.
Okay.
Okay. The endless period that you mentioned as January 2020, does it mean the financial statement of 2023?
Yes.
Okay. And also, I think I've seen a question before that this adjustment affects changes in equity. I don't know. Maybe
Yes.
you can explain better about that, sir.
Yes. We would look at the question like that today. There are actually questions like this, so which we'll look at today. But majorly that would be correction of errors, not changes in policy.
Thank you.
You're welcome. Now, estimates. IAS 8 guides us on accounting estimates, knowing fully well that most figures that we use in our reports are estimates. Accounting or reporting is not an exact science. Our figures are not accurate. So we make use of a lot of estimates, and examples of estimates in reporting are a lot. There are a lot of it. And number one is useful life of assets, whether whether PPE, whether intangible assets, but useful life of assets that we use in determining our depreciation. They are based on estimates. Another one is provisions generally that I taught you in IAS 37. In fact, IAS 37 specifically mentioned that when you want to measure your provision, you should use the best estimates of the future expenditure that is required to settle the present obligation. Best estimate. So provisions, whether warranty provision, whether a decommissioning provision, whether a restructuring provision, whatever provision you're making, they are estimates. Also is impairment of non-current assets. I've taught all of you here IAS 36 on impairments, and you will see that when you want to determine recoverable amount, you would need net realizable value, you would need value in use. And value in use is estimates, really, because you need to estimate future cash flows from that's estimate. How can you estimate what will happen how can you determine with certainty what happens in the future? So you're typically making estimates in those respects. Even the net realizable value as well is majorly estimate. Also is impairment of financial assets using the ECL model, the expected credit loss model, is based on estimates. If you remember the way I taught you, when you want to put it in stage 1, at origination, stage 2, where there is an increase in significant credit risk, right? And even when you want to determine the value of that impairment loss that you want to make, you are going to be making a lot of estimates, calculating the loss given default, exposure at default, and all of that we use in determining it. That is typically based on estimation as well. And Which other areas do we make estimates reporting aside from this? Can you give me other examples? Aside from useful life, provisions, residual value, a lot of them. There are a lot of them. Even calculation of our depreciation eventually is also based on estimates. So a lot of our figures are actually based on estimates. Now, when we make estimates are based on information available to the entity. So on the basis of the information that we have, we can make decisions, can make estimates of useful life, impairments, a lot of the estimation. Can you see my screen now?
Yes,
Yes.
sir.
Okay.
Yes, sir.
Good. So when the entity has new information, therefore means that the estimate will change. So where there is a change in accounting estimates, such changes should be applied retrospectively. Sorry, prospectively. Prospectively. This means that the change should only affect the year of change and future periods. So where there are changes in accounting estimates, you have nothing to do with your previous year estimate. It should only affect the year of change and future period. And examples are if you have a change in depreciation methods, that is either from straight line to useful life, to reducing balance. I've seen an ICAN question. They can ask you, is change in depreciation method a change in estimate or a change in policy? It looks as if it's not straightforward, but it's actually very clear for depreciation methods in the sense that depreciation method is not a measurement basis. So if you are selecting a measurement basis like cost model or evaluation model, you're talking about a policy. Then when you change that policy, then that's a change in policy. But depreciation model is just a technique. I say depreciation model. Depreciation method is just a technique that is used to get or derive your figure. That is used to derive your figure. So it's just an estimate. In fact, it helps you make the estimates, right? So when you change that depreciation method, is a change in policy. And that is why, for those of you as skills, when I taught you depreciation, you will see that when there is a change in depreciation method, it only affects it's only the current year depreciation that will change. And we then continue to use that depreciation method going forward. It does not affect the previous year's depreciation. Or if Probably there is a change in residual value, or there is a change in useful life. Those ones also affect the year of change and also future periods. It has nothing to do with prior. It has nothing to do with prior periods. And that is it for accounting estimates and changes in accounting estimate. Now let's go to the final one, which is errors. Do you have any questions for this? Okay, let me ask you something very quickly. Let me ask you something very quickly. So let's say a company had a building, and that building, they were using it for their head office. So they saw it as a PPE, and they were using cost model to value that PPE. So they then change later, maybe after some years, they decided to relocate from that property. So they started renting out that property and they were making money from it. So that means that asset is no longer PPE. It becomes investment property because now it is now being rented out. Because of that, they now changed their model from the cost model that they were using when they saw that property as PPE. They changed it from cost model. They now started using fair value model as required by IAS 40. Now, that change in model from cost model to fair value model as a result of change in use of that assets, can that change be a change in accounting policy?
No.
So what is it?
I think
Changing accounting estimates.
it's policy because the measurement will change. It will affect the presentation, measurement, and the recognition.
Okay. Any
So I
other
think
idea?
it's estimates because you cannot change it retrospectively because it's based on why they change it because of the use. It's no longer used as a PPE. So it's not really, you can't change it retrospectively because changing policy, you will change it retrospectively.
Okay. Hello, sir. So my
Yeah.
thought is that since that the asset is being reclassified from a PPE to an investment property, so therefore the changes in policy is applied here because of the reclassification of the assets. I think so we can say that there's a change of policy because the same class of assets has been reclassified into an investment property under IAS 40. So we can say there's a change of policy there.
Okay.
Hello, sir.
Yes, Jacob.
Yes, so I don't think there will be a change in policy because it is like a reclassification. It's like we are moving an asset out and we are moving another asset in. So, like we are moving PPE out, we are moving in investment property because when you want to reclassify, maybe then would recognize from PPE, then start recognizing as an investment property. So it's like a new asset that you are trying to measure at a new distance. So I don't think a change in policy would apply.
So what is it?
So it is like a change in estimate. It's a prospective application.
Okay.
Sorry, sir. Another thing, is it the same asset that was changed or it is a new asset? Because if they left the old asset and it is a new asset, then it means that it's a new asset. So, but if it is the same asset which was reclassified, so we have to stop the depreciation under the cost model and actually apply investment fair value model under the investment property. That's my thoughts. But I just want to hear again if it is the same asset that was reclassified, because that's what I said earlier.
It's the same asset though.
Okay, so there is a change of policy on the same assets because you have to stop depreciation under the cost model, the accumulated depreciation under the cost model, and then we've valued the property into an investment property, which means that it will generate rental income.
Okay. So you have all spoken very well. So it looks a little not so straightforward because if ordinarily when there is a change in models, when there is a change in measurement basis, is a change in policy, is a change in accounting policy because your measurement will change and you are going to apply retrospectively. But here, there is a change in measurement basis, but the change is as a result of change in circumstance. The change is as a result of the nature of the asset has changed. So you will not treat it as a change in accounting policy. As some of you has rightly said, that cannot be applied retrospectively because the asset has changed. Yes, it's the same asset, but the nature, the use, the accounting principle that is applied has changed. Under PPE, we don't have fair value model. But the only reason why we are changing to fair value model is because the nature of the asset has changed. And it is not a change in estimate either. So in such cases, we see that as a selection of a new policy. It's like it looks as if, okay, we are starting over again. Now, for this new nature, for this new class of assets, this is our policy now. So is a selection of a new policy. So I needed to mention that. Okay? Hope you understood that clearly. Now, another one is this, was it Onye? Now, I need to emphasize on depreciation methods. I corrected that immediately when she was saying changes in depreciation method, when she was giving it as an example for change in policy. I corrected her that changes in depreciation method is not changes in accounting policy. Depreciation method is just a technique that is used to determine that is used to apply that cost model or evaluation model. The model itself is the policy. The method is the estimate. That's what you use to estimate your depreciation. So the depreciation itself is the policy, whether you're using cost model or evaluation model, that's the policy. But the method that if you change from straight line to reducing balance, that is a change in it only change the value of the asset. It changes the estimate of that asset. And again, another reason why changes in depreciation method is a change in estimate is because you only change depreciation methods if there is a new information regarding the pattern of economic benefits. Under IAS 16, you don't just select depreciation method. You select it based on the expected pattern with which the asset will generate benefit. If an asset is expected to generate benefits equally over its useful life, you're expected to use straight line method to determine your depreciation. If the depreciation you would if the pattern of benefit will undulate, if it will reduce over the years or increase over the years, you would use another pattern, another method, not straight line. So when you change, it means that you have new information. You have new information at your disposal, and it is on the basis of new information that we make estimates. So changes in depreciation method is a change in accounting estimates and not a change in accounting policy. Okay. Now, to be sure that you understand that, let me ask you another question. When you select the initial selection of your depreciation method, whether you want to use straight line, not the changes thereof later on. I'm talking about the initial selection of whether you want to use straight line or reducing balance method of depreciation. Is that an accounting estimate or selection of accounting policy?
Selection of an accounting policy.
Selection of accounting policy.
It's an accounting estimate.
An accounting estimate.
Sorry, sir, can you repeat the question?
Size an
Yes, sir.
accounting estimate.
An accounting estimate. So Samuel, we said that the initial selection of depreciation method, we said, is it an accounting estimate or selection of accounting policy?
Accounting estimate, sir.
Okay.
Why
Okay.
is this accounting policy?
Okay. All right. So those that say selection of accounting policy, yes, you guys are correct. You guys are correct. So, and the reason is this, at the point of selection, you are not making any estimate at that point. It's only when you start your calculation. So the initial selection is a policy choice. The initial selection, I mean, these are specific areas that are a little confusing, but I need you to imbibe, and that's why I'm mentioning it specifically. So the initial selection is a selection of accounting policy because you're not making any estimate at that point in time. You're not. So it's going forward at the end of each year, then you estimate. So selection or a choice of methods between straight line or reducing balance is not an estimate yet. You are selecting a policy. So if you now change it, at that point, you want to change an estimate. At that point, you want to change the figure that you're going to use. So yeah, it looks a little confusing, but it is what it is, the way it is mentioned. It is as simple as it is mentioned. Okay, you want to select a policy, a method. That's a policy. Okay, then you started using it to determine your figures. You now want to change that method. That means you want to change that estimate. It becomes an estimate. So it only applies in that respect. Other ones are very clear. Other ones are actually very clear. Another one that is not clear is this. Let me ask you. So, of course, you know that when you select, let's say you want to use FIFO or weighted average for your inventory valuation, you should know by now that that's a selection of accounting policy because you're selecting a valuation approach for your inventory. So if you now decide to change from FIFO to, let's say, weighted average, is that a change in estimates or a change in policy?
It's a change in policy.
The change in policy.
Estimate.
Sorry?
Estimate. Change in estimate.
I'm with you. I just want to help you note it down. It's actually a change in policy. So, as cost model and evaluation model is for PPE, that is how FIFO and weighted average is for inventory. That's the policy choice. Okay, that's the policy choice. So there are ways at which you apply FIFO, there are ways at which you determine the figures. There are techniques that they use there, but the measurement basis for inventory is FIFO and weighted average. So when you change that measurement basis, that's a change in policy. So, and that is why it's a change in policy. Okay. So all that I've mentioned, so important, so keep it. Now, the final one is errors, right? So errors are mistakes or misapplication of accounting policy. It could be fraud. It could be arithmetic, mathematical mistakes, but you see, when errors are made and discovered in the current year, that one is not what IAS 8 wants to look at, because you simply correct it in the current year. Okay, so the issue arise where there are prior period errors. Prior period errors. When there are prior period errors, that's where the issue arises. And you see, these are errors. These are errors that occur in the previous period. In the previous period, as a result of omission, misstatements of figures. that were misused. So you can define it in some other way. So the basic thing is that this error, they occur in previous period, either as a result of omission, misstatement of figures that you misused, and or as a result of misuse of information that were available when the error occurred. So not that the information was not there, the information was there with you, just that you misused it. Yeah, as I was saying, so when errors are then made, then the most important thing is these errors need to be corrected. How do you correct prior period errors? We need to correct them. So prior period errors are corrected retrospectively by by restating the opening balances of the comparative period, or restating the earliest prior period's opening balance, just like we did for accounting policy as well. So the same thing we do for year 2. So meaning that an additional statement of financial position will be required for the earliest prior periods presented. So when you want to correct errors, you correct it retrospectively. So you have to go and restate opening balances of comparative periods, whether you're changing your assets, your liabilities, or majorly your equity, depending on what item that error affected. Or you can go as far back as possible, the opening of the prior periods like that, just for you to correct the errors. And I've mentioned examples of these errors. It could be as a result of either, it could be mathematical mistakes, Abi. It could be misapplication of accounting policies. What again? It could be fraud. It could be fraud. It could be, what again? Could be a wrong.
Error.
Yes. Yes. So is that, I think that's more like, is that arithmetic? There are a lot of them like that. So, and that's errors. And you see, when errors are made, you need to do a lot of disclosures. You need to explain the nature of the errors to us. You need to actually tell us how you have corrected it, the adjustments you made in the current and prior periods. You need to tell us all of that for corrections of errors. Okay. So let's solve this question. Ifua, you here?
Yeah, can you hear me?
Yes, please.
Okay. Question 4.3. Kano Transport Company, KTC, is preparing its financial statement for 2014. The draft statement of changes in equity is as follows. KTC has now discovered an error in its inventory valuation. Inventory was overstated by 70,000 naira at 31st December 2014 and by 6,000 naira at 31st December 2013. The rate of tax on profit was 30% in both 2013 and 2014. Required: prepare the restated statement of changes in equity.
Okay, so when you look at this question, they give us the financial statement for 2014 and is a statement of changes in equity. We're given the comparative period and also the current period. So there was an error in inventory valuation, which was an overstatement by 70,000 at the end of 2014 and 60,000 2013, and the tax rate is 30%. So now, since this error was discovered after the report has been prepared, the best we can do based on the information given to us is, as far as inventory is concerned, it will have only affected our profits. The overvaluation in 2014 will have affected these profits of 2014. The overvaluation of 2013 will have affected the profit of 2013. But now that it has been discovered, then we need to correct it. Then how do we correct it? It's straightforward, eh? So you need to look at when you have closing inventory, what impact does it have on our profits? Would it have overstated our profits or understated our profits? Can we answer that first? Is there anybody that can? Because if you're able to figure that out, then I don't think you have any issue anymore. So this overstatement of inventory, of closing inventory to be specific, so what impact would it have on our profits? Would it have overstated our profits or understated our profit for both periods? Who can tell us?
It will
Since it
overstate our
It overtakes.
profits.
Okay, so let's hear from Onye. She said it will overstate our profits. So tell us, how does inventory overstatement overstate our profit?
Hello, sir. It will not impact the profit. It will be understated of profit because it wasn't sold. It's a closing balance of inventory. So it remains in the balance sheet as unsold stock, but it's in excess of the value given here.
Okay, all right. So I think you have explained your own clearly, Samuel. So let's go back to Onye.
Okay.
Let's go back to Onye. You said it will overstate our profits. You have not explained how. Okay, she doesn't have
Okay.
explanation.
Okay. I didn't actually get it right. So that's why I think Samuel is correct.
Yeah.
I want
But for
Unfortunately,
me,
I
I
want
didn't. I think I'll still stay with my overstated upper because his own explanation shows the physical representation of what is in the company. But what we want to treat here is the error that is in the book. So the reduction they will have made to get their cost of goods sold will have affected the gross profit stated. So that's why I gave that point.
okay, so I think Lukman has actually settled it. That's perfectly correct. That's perfectly correct. So it will have overstated your profits because you would have understated your cost of sales. You know that closing inventory is usually deducted from cost of sales. It's usually deducted from cost of sales. So now that you have deducted so much from your cost of sales, so your cost of sales now looks small. Your cost of sales will now be smaller than what it should be. And when your cost of sales is now small, it will now make your profit to be higher than what it should be. So yes, your initial instinct was correct. And Lukman, yeah, you stood by your answer, which is perfectly correct. So inventory overstatement would have overstated your profit. Another way of looking at it is that in closing inventory, when I teach you IAS 2, because I will still teach you IAS 2 on inventory, we see it as it's like an income. It's like an income. Of course, anything that reduces your expense, because closing inventory reduces your cost of sales, is an income. Or we can see it as a potential income. is a potential, not an income yet, but a potential one. So it's an income. So if you overstate it, you overstate your profits. Okay, so if everyone agrees with that, that this error, this overstatement of inventory would have overstated our closing inventory, our profit, I mean, then that means we are done. The solution becomes very clear. Solution is very clear.
Okay. So sorry, sir.
Yes, I'm with you.
So, okay. So with respect to that question now, is we are restricted to just addressing the area of impact on profit. Does it mean that that is what we should focus on? That we should not think outside the relevant information that is presented?
Oh, yes. Oh,
Okay.
yes.
Because my thought was that since the balances was overstated in the book, so what it means is that it wasn't sold. So I think now to rephrase the question from the explanation the other guy is giving, it's clearly showing that seen as much as it wasn't sold does not mean that it won't understate the what's it called, the cost of sales. But we're not told whether it's a purchased inventory or probably it was produced in-house. So I think
you don't need that information. What do you need that
we don't need
information?
that information. Oh, okay. Okay.
You don't need that
Okay.
information
That's
for.
what it's saying.
Yeah,
Thank you very much.
you're welcome. So yes, and again, yes, Samuel, just restrict your solution to the available information that we have. So there's no way we would have adjusted the inventory in the statement of financial position since we're not given any figure, any statement of financial position. So, and in exam, they won't even give you, they will not. So if they have, that means they want you to just only one item. You know, and I mean, it's not a good use of your time in the exam. But this one, they can test a lot of things, as you would see now. So if you want to solve this, so all I just need to do is just to update these profits. Then I will prepare my statement of changes in equity again. Okay. So I can call this my workings one. My workings, which is adjustments of profits for 2013 and 2014. What's the stated profits that they gave us? What was the profit given in 2013? 150. This is how we usually present it. 2014 should be here. 2013, and let me put my error. So my stated profit of 2014 is 385, and 2013 is 150. Okay, so what are the adjustments that is required? Number one is the overstated closing inventory. How much was it? 70. How much in 2013? 60. This 60. So what do we do with this overstatement? Are we adding it or deducting it? Are we adding or deducting this overstatement?
We are deducting it, sir.
Okay, so we'll deduct it. Deduct. But a lot of students will forget that since the closing inventory of 2013 was overstated, they will forget that it should become an opening inventory in 2014. So they will forget to make these adjustments. They will have forgotten. That means 2014 opening inventory has also been overstated by the same amount. And for that reason, I will need to then do a kind of so the net effect now, if I want to focus on these adjustments, this will be -10, and this will be -60. So the key question is that, why am I adding this? The easiest way for you, if you don't want to think too much, is that since overstatement of closing inventory will be deducted from profits, then overstatement of opening inventory should be added to profits because they have a reverse effect. Opening inventory is usually added to cost of sales. If you remember, opening inventory plus purchases minus closing inventory. So while you deduct closing inventory to derive cost of sales, you actually add opening to derive cost of sales. So that means your overstated opening inventory would have understated your profits. So you need to do the reverse effect for this 60. So for me, I will not even think too much. Since I'm removing closing, then I should add opening. It has a reverse effect. That is one. Two, another thing students would omit is the fact that because we had overstated our profits because of with these amounts, it means that we had also overstated the tax because that was why the examiner gave you tax rate of 30%. It means we have overstated the tax as well. That also needs to be reversed. So you need to get the tax effects at 30%. So this will be 3, 30% of 10, and this will be 18. In the sense that by the time you do your adjustments, that overstatement of tax also should be adjusted. So now the net effect after tax. So the only thing I'm removing now is just 7 for this. And the only thing I have to remove here is 42. So from here now, my restated profits was 385 minus 7. That will be
370.
378, abi?
77.
77. What about this? 108, right? This 108.
5 minutes.
That's 150.
378 is correct.
370.
Okay, 378. Okay. So this is the major workings here. And everything starts with getting this one right. If you get this one wrong, problem. And remembering the fact that the opening inventory, the closing inventory of 2013 will become opening of 2014. So you then come and get a net effect. And don't ever forget the fact that taxes will have been applied in the prior periods on these profits. Taxes have been overstated. So you need to just adjust for taxes now so that we can get the net effect after tax. Then you can then go ahead. So if I then want to prepare our statements now, should look something like this. My statements of changes in equity for the year ended 31st December 2014. So for 2013, I have my, let me see if I can copy it and it aligns perfectly. Hopefully, good. So 2013, these are my opening balances. They won't change, but this my profit for the year become a restated profit for the year. So this 150 for 2013 becomes 108. This is 108. So that means this 240 becomes how much? 198. And this one becomes 748. And this profit for the year in 2014, this becomes 378. And this becomes 378. So can you get me what the balance here would be? 98 plus 378.
476.
476. What about this? That's 648 plus 378.
1026.
1026. Okay. Do we have any questions?